Hello, I'm Richard Parfect, and I look after specialist assets research within MGIM. Within that, I cover infrastructure assets. Within our infrastructure allocation, we hold diversified infrastructure trusts that span across several sectors in what is a large and rapidly growing space. However, alongside that, we also seek to target one or two specific sectors that are demonstrably benefiting from a number of structural tailwinds. In the past, we targeted a selection of renewable energy generation trusts. However, that allocation has reduced as valuations have increased. Nevertheless, more recently, we have introduced Gore Energy Storage Fund, a London-listed investment trust. The resounding success of the increased supply of renewable energy generation has inevitably had some unintended consequences, some of which Gore Street is seeking to address. I'm pleased to introduce to you Alex Okunade, the CEO of Gore Street Capital, which manages the trust with an extensive background in renewable infrastructure. He is ideally placed to take us through the huge energy transition that is well advanced in the UK and increasingly overseas. Over to you, Alex.
Thank you, Richard. Thank you for inviting me here today. I'm going to talk about the energy transition as an investment opportunity. As Richard mentioned, my name is Alex Okunade. I'm the founder and CEO of Gore Street Capital. We're a firm that was founded in 2015 to look for the opportunity driven by our transition to a low-carbon economy. My background is over 20 years in private equity, but the majority of that time has been spent investing into the world of renewables. So from 2006, I was out in Abu Dhabi, where I was head of investments for a large sovereign fund focused on renewables, and then founded Gore Street in 2015. Today, I'm going to talk about the transition, some of the drivers, what it means for the market, the impact, and therefore how the opportunity arises. In particular, I'm going to talk about two investment themes that Gore Street has developed and is executing against, one on energy storage and the second on hydrogen. I'll give a little bit of background then on Gore Street and how we've approached this market in terms of our skill sets and what is needed to be a good investor here into the transition. So, Gore Street Capital, as I mentioned, we were founded in 2015. We're headquartered here in London, around 25 investment staff. Interestingly enough, when we founded the firm in 2015, a very typical group of individuals in that investment banking, management consultancy, investment professionals. Over the period since we founded the firm in 2015, our organization has grown to be about 50% technical. So we have a lot of our colleagues are electrical engineers, chemical engineers, project managers, contract specialists. And I think that's a really interesting mix and one that's very important as we look at the complexities of investing into the energy transition. So, why is it happening? Here we can see on this slide some of the recent photos, all from this summer. I think it's quite incredible, even though I've been involved in the world of energy transition for quite a while. This year, I think, like for so many of us, has really brought home the criticality of the issue we're faced. We can see flooding throughout Europe. We see intensity in hurricanes and tornadoes across Asia and North America. We see wildfires as far as we can see across Greece, Turkey, California, Oregon. And all of these things were totally predicted. The models are actually falling out exactly as the scientists had pointed. We're living in a world which is getting much wetter, much hotter, and weather events are getting more and more serious. Obviously, policymakers, governments, and now I think the private sector is focused on trying to see what we can do. But it is very apparent to everybody, I believe, that the issues we're faced with are serious for our welfare, for our health, and for our society. So, What does it mean then for the drivers? We see the problem. We've massively overused the energy resources, which are carbon intensive. We've warmed the planet. That warming has driven terrible events in terms of weather. It has made the world hotter and wetter, as I just went through. But what are we doing in the private sector, enabled by government, to combat things? Energy is and has been the first sector that really both private sector and government have mobilized behind in terms of fighting against climate change. It's quite easy to understand why. Energy and our use of CO2 emitting fuels is the driver of climate change, and therefore the first natural stop to help fight against climate change has indeed been energy. I'm sure many of you in the room are investors in a range of different energy activities, whether it be traditional energy companies or the growing wave of renewable energy companies. On the renewable side, what we have is a really interesting differentiator from what was traditional energy investing. We have a technology-enabled asset class. The huge progress we've seen in terms of decarbonisation of our society here in the UK, offshore wind throughout North America, really driven by solar. The rise of offshore wind and the rise of solar have been driven by technology advancements. So we need to understand that as we're investors into the energy transition, we are investors into a technology which is enabling that transition. So very strong price declines in solar and wind, leading to a massive change in the energy mix. Originally, though, that has been supported by policy. With the technology advancements, you needed policy to support the growth of that new technologies. And so what we've seen across the Western world is governments putting in place strong policy support mechanisms to enable really the start of these transitions. What is now interesting, though, is those policy subsidies, policy enablement have been weaned off. To be an investor these days in either solar or wind across the Western world, you do not need a government subsidy anymore. Those technologies are now cost effective against hydrocarbon generators. We also need to think about culture. When I was starting investing in energy back in 2006, people were concerned for sure around climate change, but I would still say it really wasn't a mainstream investment opportunity. It's only really in the last 4 to 5 years that you see a culture of acceptance around, one, the importance of these technologies being rolled out to decarbonize our society, but two, an acceptance that actually they are appropriate and profitable investment strategies. So we as the investment community have got behind and now understand the importance, but also the profitability of these investment strategies and where they should sit in your portfolio. So I mentioned it, falling technology costs. We can see it here on this slide. I've picked out lithium ion. The reason I've picked out lithium ion is Gore Street is a very large investor in energy storage. So we're very focused on tracking the cost declines in lithium ion. Renewables, unlike traditional energy infrastructure investing, is one where you invest the vast majority of your capital up front. Right? So you have a large capex on day one. Your running cost is a very small percentage of O&M, and of course you don't have a feedstock, right? We're not burning oil or gas to produce electricity. You own solar or wind, your feedstock is free. So a lot of attention therefore has to be placed on exactly the capex. Are you getting the right capex that allows you to be profitable over a 20 to 25 year lifespan? This graph on lithium ion, one we track very heavily. We're a large buyer of energy storage systems, and the cells are one of the major components of cost. And so what we see in lithium ion is a very steep decline in overall system cost. What's that driven by? That's driven really by manufacturing excellence. Large Asian manufacturers have scaled up really significant capacity to access the market and to avail of the market opportunity. We are, of course, in transportation undergoing a transformation just like in energy. That transformation is the move to electric vehicles. The large Asian manufacturers have scaled up their battery manufacturing capacity to, in essence, replace every internal combustion engine in a car with a battery. That scaling factor has generated a very significant decline in lithium ion and therefore opening up actually batteries to a whole range of new applications, something that Gore Street since 2015 has been profiting from in terms of our portfolio providing grid balancing services. If we put up a solar PV chart, the cost of solar PV, and taking it back a few years, so if our chart started from 2006 and went out a decade, you would see a very similar price decline. So if you look at the major technologies which are enabling our transition to a low carbon economy, what we see is the significant price decline, in the main driven by manufacturing capacity and expertise in manufacturing, plus with new technology developments, and therefore enabling a market to exist for those asset classes into our transition to a low carbon economy. What do we mean then? How do we think about then the market? So where we've come to so far in this presentation, talked about the problem. The problem is we have rapidly warmed our world. That heating is causing significant stress on our society, loss of life, loss of wealth. We're reacting to that with a combination of policy and a combination of new technologies at scale, allowing a transition to take place in many sectors, but energy as the largest one. This graph here talks about market overview. How have we taken this? How have we come up with what a market might be here? The numbers are staggeringly huge. We're talking in the trillions in terms of replacing hydrocarbon infrastructure with a renewable source. We estimate anywhere between 2 to 4 trillion pounds of investment. And that is to hit our goals. So what we've done here is we've said, we have goals, Paris Climate Agreement, talking about 1.5% in terms of limiting the increase in temperature. To do that, to be able to make that goal requires Y amount of investment. That's how we think about market overview. So policymakers have come together and said this is where we need to aim to, this 1.5% maximum limit, and sadly it seems that we're not going to make that, but there is many activities to try and help that. But to do that, to actually limit the warming to 1.5 requires a replacement of hydrocarbon infrastructure and thereby giving us this very large market opportunity. So what does that mean in impact, right? So we're working through a large market opportunity enabled by policy in reaction to very significant pressures that we're seeing. The impact then in terms of how we invest over what time, we're now really at I would say, of all my years investing in renewables, the amount of capital that is becoming available, the amount of impetus behind the use of that capital we've never seen this type of market before. So more and more asset managers, such as ourselves in Gore Street, are putting up different propositions to understand, to unlock different ways to enable our energy transition. More capital is being made available by the insurance companies, the pension funds, the large institutions, right? And really interestingly enough, that capital is also willing to take what now I believe is more acceptable rates of returns. We used to see that to invest in renewables back in 2006, 2007, people would want either a very large return or they'd want a government guarantee. The government guarantee is gone, right? So we're now operating in a subsidy-free environment. And what we have is actually investors looking at their cost of capital and looking at the risk profile of these investments and pricing in the main energy infrastructure, renewable energy infrastructure, in the mid-single digit level of returns. In Gore Street, we're generating higher than that. Energy storage, there's, I think, more complexity that we had to take on board, but we're generating a 10 to 12% return. Over time, that probably will go down as complexity gets removed from the market. So what's changed then, right? We have large amounts of capital coming through. We have large amounts of technology improvements driving down the cost. I think one of the really interesting things here in the UK is the rise of offshore wind. The UK made some really interesting policy decisions back in 2010 to 2012. Some of those policy decisions, to be honest, were driven by not wanting to build onshore wind, not wanting to build solar. Politically, it was hard for the government to get that through. People didn't want to have wind farms in their back garden. So the government focused its attention very heavily on offshore wind. And the UK is without a doubt the leader in offshore wind globally in terms of deployment and the use of. So the UK has done an amazing job on offshore wind and driven the cost down. Where I invested, led a transaction on behalf of Masdar, the Abu Dhabi Sovereign Fund, in a deal called London Array, a very large offshore wind project. And the cost of that project compared to the cost of offshore wind today is a fraction. It's in the 10 to 20%. So really quite incredible improvements in the cost while still delivering a very strong return to the investors. So again, we see this momentum, we see the problem, we see the policy moves, we see the technology developing at a lower cost point, we see investors getting more and more comfortable with that, while we recognize a very large investment opportunity in front of us. All right, to hit these goals, we need to radically transform our energy system. And though I've never seen the market like this in terms of culture and appetite and availability of capital and interest, we need to do more. So here, I think kind of captures that, the energy transition, the energy investment opportunity is large. I would say it's also complex. In Gore Street, we chose to look at the complexity side of the investment equation. So I think what we've done a very good job of is we're not an investor in solar. We're not an investor in wind. I think there's some very good players who are doing a very good job of mobilizing significant capital and putting it to work in those. And they're very mainstream asset classes. In 2015, 2016, we as a firm made a decision that we wanted to focus on the more complex asset classes that were still required to enable our energy transition. Energy storage for us was that asset class. We've been investing in energy storage now since 2016. We have a very large portfolio across the UK and Ireland. And that asset class is, for sure, more complex than investing in solar and wind. We're doing many things with these, with our systems, but we're generating a much higher return. So we're happy to take on that complexity because we see the opportunity in terms of our rates of return. There is multiple opportunities like that. To really grab hold of this investment opportunity, to really actually fulfill our goals in terms of what's happening with climate and being able to transform our energy system, requires us not just to look at the mainstream, not just to look at wind and solar, but to look at storage, to look at hydrogen, to look at various other different asset classes, all of whom sit today as offshore wind would have sat in 2006. So this rapid change in investor perception of the difficulties and the needs for different asset classes. And that's really driving the opportunity for Gore Street. I've touched on energy storage. Let me go into it a little bit more detail. This is obviously what we do for a living. What are the drivers that enabled the asset class that is energy storage? I've touched on some of them. What we have is a rapid decommissioning of gas, to some extent nuclear, definitely coal throughout the UK. So what we have is very steady state baseload power being taken off the grid. These are terrible generators in many ways, obviously causing this climate emergency that we're in. But what they do is they generate power very stably over a long period of time. So this baseload power. But that's getting less and less. We're decommissioning them. Coal is basically, coal is basically not functioning in the UK market at various times during the year. What's changed then in the energy mix? Offshore wind. Some onshore wind, some solar, but in the main driven by offshore wind. So offshore wind is replacing baseload power. Offshore wind is an excellent generation source, and over a medium to long term, very stable in terms of understanding how much power is going to be produced. It is, though, intermittent. So on a short-term basis, it's hard to understand exactly how much energy you might be producing from your offshore wind power plant. The wind blows, the wind doesn't blow. That intermittent nature changes the energy system. The energy system, baseload power, coal, gas, nuclear, now moving to offshore wind, onshore wind and solar, intermittent power, very good over medium to long term in terms of projections. On a short-term basis, a day-to-day basis, hard to know exactly how much power you'll be driven. Then you add in another complexity into the energy system, which is on the demand side. So we talked about the supply side, but on the demand side, what we have is the rise of the EV. I think it's a really interesting phenomenon in that, we fuel our cars with petrol. We're moving to not to take our cars and plug them in. Suddenly that's a massive change to the consumer demand, the demand side of the energy system. And the grid operators who have a responsibility to keep the grid functioning to deliver safe, secure electricity consumers have a much more complex picture to manage. And that's where energy storage comes in. Energy storage is a balancing mechanism on the grid, allows grid operators to deal with the imbalances of renewable power, to deal with the changing demand side in terms of the rise of EV, and allow us to really get rid of hydrocarbon generators from our grid. That's driven a massive expansion in energy storage. We were one of the first players in energy storage here in the UK. We started investing in 2016. We listed our fund in 2018. And for us, we knew this market would happen. We knew energy storage needed to grow as an enabler for our energy transition. We are still, though, surprised at the speed. Energy storage is now mainstream accepted as a critical asset class and continues to grow in importance. I mentioned earlier, the mix of being an investor, what kind of people you need. I think energy storage really demonstrates that you need to approach this asset class as a hands-on manager with a different skill set. Of course, the role of investment professionals, I'm not an engineer, I'm an investment professional, is critical in the origination and the execution and the management of these assets. But it needs to be supported and it needs to be co-led by colleagues of ours on the electrical engineering side, the chemical engineering side, the energy trading side. Right? All of those skill sets need to come together to really profit from this investment opportunity in energy storage and hydrogen, which I'll also talk on a little bit. I think that's quite unique, what we've built in Gore Street, but I think it will become more and more apparent to every investor that you can't approach some of these asset classes, which are critical to our transition to a low carbon economy, but are still complex and need a lot of hands-on management without bringing on a quite diverse set of skill sets. So, how are we then investing? So we have our listed fund. We continue to grow that. We started that at a modestly sized £30 million back in 2018. We're now around £340 million. So very strong growth. A strong growth driven by us adhering, of course, to what we said we would do for our investors, which is build a large portfolio of energy storage assets which contract with the grid operators to keep the grid in balance, thereby enabling more and more renewables to come on the grid, less and less hydrocarbons. Critical component of our transition to a low carbon economy. We target a 10 to 12% return for that. We think that's an excellent return for what is in essence UK infrastructure with customers such as the National Grid or in Ireland EirGrid. So very strong customers with large amount of financial resources, and we're providing a critical service to them. That investment approach hasn't changed since 2016. I think what we've seen as the market develops is more and more uses for our assets. So we're providing more and more services from our existing portfolio in terms of grid balancing, in terms of energy trading, in terms of capacity. Lots of ways for us to make money. And in all of those ways help and enable our transition to the low carbon economy. What does our portfolio look like? I'm so proud of the work my colleagues have done here. We started out with one asset. Of course, everybody starts with one thing, a 6 megawatt facility, which we still own up in North Yorkshire. At the time we commissioned that was the largest privately owned lithium-ion facility in Great Britain. It was the largest in the world doing frequency, which is the grid balancing contract. Our assets now range from 50 megawatts to 100 megawatts, so really massive growth in scale. Right? That scale enabled by significant declines in technology and a very supportive culture, investment culture. So a portfolio throughout UK and Ireland. We're one of the largest owners of energy storage, I think, globally. And over the next few years, we're expanding out of the base we built in the British market and the Irish market into North America and mainland Europe. Thank you all for your time. What I hope I've conveyed through the presentation is some very big macro themes. Right? Macro themes that are apparent to everybody more and more in terms of the seriousness of the situation that we face, a situation driven by our use of hydrocarbons for our society, for energy for our society, necessitating an energy transition, necessitating a change in the energy mix, and one which I think we're very successfully embarking on. Right? I think the energy transition, especially here if we look in the UK, is very successful. We've driven, the large manufacturers of technology have driven down the cost. The financial community has provided the capital, government has provided some interesting policies that support this transition. And that transition needs to encompass many different asset classes. I've talked briefly on solar and wind, especially offshore wind. I've talked about what we do in terms of energy storage as a critical component of the transition. Those asset classes continue to grow. They're more and more are complex. They require an investment approach which necessitates multiple skill sets, not just investment professionals, but technical as well. And we also need to think about our role in the community. Everybody, I think, another probably overused tagline around ESG. We're very concerned with ESG. Everybody should be very concerned with ESG. I worry though I hear the phrase too much, I hear the initials too much, and people will end up getting tired of it. They can't get tired of it. Because ESG, really what it means is our focus on the importance of what we do. We know we're making a difference. Right? We need to make a bigger difference. The problems we're facing are huge. We need to track what we're doing. We need to explain what we're doing. And we need to work with multiple organizations to make sure that all our stakeholders, whether they be the manufacturers, the underlying investors, our customers, are aware of how we are approaching our energy transition. ESG for us is integral to our activities, right? It's not a separate activity. It's something in origination, in execution and management of assets, our impact on the community, how we're tracking that and how we're explaining that. So I'm wrapping with this comment on ESG, not because I've left it to the end of the presentation, rather because ESG informs our activities. We start with the problem around our climate. We look at how to solve that problem in terms of investing in renewables and building renewables and lowering cost. All of those, to me, are ESG activities. Right? We shouldn't think about ESG in isolation. We need to think about your activity as an ESG investor. Thank you very much.